In this second video on dividend policy, let's look at some of the market imperfections that may affect the value of making changes in dividends. So if a company has free cash flow, that's what determines the level of payouts. So in a perfect capital market, the type of payout should be irrelevant. But again, as we mentioned, in reality, the market's not perfect. So we want to explore these imperfections to see how that would affect the value of the company. So let's think about the tax disadvantage of dividends. We know that shareholders have to pay taxes on dividends. You also pay taxes on capital gains. But dividends are effectively taxed at a higher rate since long-term investors defer the tax that they pay on capital gains until sometime in the future when they sell their stock. So while the current tax rate is not different, capital gains are deferred. So that again brings us to our conclusion that dividends are effectively taxed higher than capital gains. So that is a disadvantage to paying dividends to our shareholders. So the higher the tax rate on dividends makes it undesirable to raise funds and use those funds to pay dividends. If you remember, this was really our third strategy a while ago, was to not just pay the current dividend and any growth in that dividend, but let's borrow even more money and pay all of that out. Since there is this tax disadvantage to shareholders, we would not want to impose that penalty on them. So we wouldn't ever borrow money or gather funds from outside and use that extra money to pay on dividends. So let's think about an optimal policy if we take taxes into consideration, right? Again, if taxes on dividends are greater than capital gains, right, shareholders are going to pay lower taxes if the company buys back stock rather than paying dividends. In other words, they're still going to pay the same tax. This tax savings that they receive now is ultimately going to increase the value of the firm when it uses share repurchases rather than dividends. So the optimal dividend policy then is to pay no dividends at all. The payment of dividends has declined in general over time, that fewer companies are paying dividends. Certainly they're not increasing dividends, and they're replacing increased dividends with stock repurchases. So can we explain why companies continue to issue dividends despite this tax disadvantage? And I think we can do this through something that's referred to as the clientele effect. Essentially what this is saying is that companies will attract investors who not only like the company, that not only like the rate of return they're receiving, but they like the type of return they receive. So when you receive a return, part of that return can be dividend income, and part of that income can be capital gains income. Now, according to tax laws, obviously, the tax that's paid immediately on those two types of returns is different. So the company is going to attract investors that like the tax consequences associated with their particular dividend policy. So again, if we think about what is the effect of the dividend tax rate, what is the effective tax rate? We have this T sub D here is ultimately the tax rate that we would see based on the company's taxes and also on the taxes of the individual shareholders. T sub D is the tax that's paid on the dividends, and T sub G would be the tax on capital gains. So this effective tax rate is dependent on the tax consequences of the individuals within the company. So the effective tax rate, again, just try to reiterate this a little bit more, says, look, the actual effective rate depends on the investor as much as it does anything else. Their income level, the investment horizon of the company, and the investment horizon of the investor, the tax jurisdiction they live in. So as a result, investors have varying preferences regarding dividends, and they will gravitate towards the company that offers the preference that they want. So this clientele effect says that when the dividend policy reflects what investors want. So when a company changes its dividend policy, the old investors are going to sell their shares to new investors. There's no change in the demand curve, since the new investors want this stock as much as what the old investors wanted. So the clientele effect basically reflects the same thing we've been talking about, and that is that the payout of dividends has very little influence on the value of the company's stock. So now, let's think a little bit further. In a perfect capital market, what happens after we've done everything that we want to do, right? We've done all the positive net present value projects, we've paid all of our bills, and we still have cash left over. In a perfect capital market, a company's indifference between saving that cash and paying it out. Now, again, in our world, we have market imperfections. So retaining cash can reduce the cost of raising capital in the future, right? If we have cash on hand, we don't have to go outside the market to gather funds from issuing stock and or issuing more debt. But it also can increase some taxes and agency costs. So if the company has already done all of its positive net present value projects, any additional investment implies negative net present value projects, or at best zero net present value projects. So rather than waste this excess cash, a company can use the cash just to buy financial assets. And as we've stated in previous videos, in perfect capital markets, buying and selling securities is a zero net present value transaction, so it should not affect the firm value. With perfect capital markets, retention versus payout, it's irrelevant. So if a firm invests its excess cash in financial securities, the company's choice of payout doesn't affect the initial share price. But corporate taxes make it costly to company to keep taxes. Cash is the equivalent to negative leverage. So the tax advantage of leverage implies a tax disadvantage to holding cash. So the decision to pay out rather than retain cash can also affect the taxes paid by shareholders. If you retain cash, we have to pay a corporate tax on the interest it earns. In addition, the investor now will own capital gains on the increase in value of the company from the earnings from this retained cash. So again, we're going to start paying tax this time. We have this concept of double taxation. So in the end, we have to finally, again, adjust the actual tax rate based also on the taxes of the corporation. So if a company paid cash to its shareholders instead, they could invest it, and they could only be taxed one time on the interest if they earned it. So the cost of retaining cash depends on corporate taxes, capital gains taxes, and it also has an impact then on the ultimate taxes on interest, right? So we can talk about and keep fine-tuning this tax impact of paying dividends or not paying dividends, and how does that ultimately affect the overall cash flow, the overall value of the company.